Elimu Mtandao. Today, under the subject accountants, we are going to see the topic called investment as part 2, and we are going to see how can we use CAMDIV approach when we're dealing with the transaction relating to investment. Before that, let us see the format. Then this is the format of investment account. You start with the name of the owner, company, or it depends. And here it is a percent given for that kind of security. And we have on the debit and credit the same NIC, that N stands for nominal, I stand for interest or income, and C stands for the capital, principal, or cost. It depends on the book. And this is what we call CAMDIV approach. So let us have this example here. XYZ purchase of shilling 100,000, a 6% government stock at 90 CAMDIV. Brokerage charge of shilling 1,200 on 1st March 2017. Interest is payable on 30th June and 31st December. The requirement is to prepare for the year ending 31st December 2017. So how can we record? This is our investment account. We have already been prepared here. So let us see, before posting we need to do some calculations relating to this one. Okay, so the nominal, so first of all we need to find the cost. So the cost for this one, you are going to take shilling 1,000 times 9%, which give us this as a price or cost. But because we have brokerage is part of the expenses, so it should be added with this particular amount. So we have to add here with the brokerage, and the brokerage charge here, it is 1,200. So if you are to add, it should be 91,200. Okay, so this is the cost. But under CAMDIV, we are saying that the right of receiving the interest goes to the buyer. So if you are going to draw the line of this kind of transaction, if you are going to draw the line, here it is 30th June and here 31st December, the time for receiving the interest. So we are saying that the transaction took place on 1st March. So it means that from January up to this March, this security was held by the seller. So from here, the buyer will be taking the possession in ownership. Here, the buyer. But we are saying that the next interest under CAMDIV, the one who is going to receive the interest is the buyer. So by looking here, you can see that the interest that will be received on 30th June, there will be a portion of the seller interest. So on the price under CAMDIV, obvious, most of the time, they include the interest of the seller, simply because the right goes to the buyer to receive the next interest. So for that case, it means that inside of this amount, there is a portion of the seller's interest. Now we need to know how much we paid as the interest of the seller, but how much was the real net cost of purchasing this nominal value of 100,000 6% government stock. So let us find. Okay, so let us find the seller's interest, or what we call accrued interest. So from January up to 1st March, there are 2 months. So we are saying 2 months out of the total 12 times the percent of that stock, which is 6%. So we multiply by 6%, multiply again with the nominal value, which is 100,000. So we'll be getting here the interest of the seller, which is equivalent to 1,000. Okay, so this will be the interest of the seller. So we need now to deduct, so that with this amount we need to deduct so that we can get the net cost for purchasing this, which will be equal to 9,200. So this will be the net cost. Now how can we record it? When you are recording, we have to make sure that we record as follows. So we write the date. The date it is 1st March but it's 2017. Here we are paying money, so we write here bank, but in bracket you can write purchases that we are purchasing. We are purchasing nominal value of shilling, this one, and the interest that we are paying, it is 1,000, so we put here 1,000. Then the net cost to be remained with the 90,200. So this is how we record there when we are purchasing. But now on 30th June, we are going to receive the interest at the buyer. So we are saying that on 30th June, as part of the working here, 30th June 2017, interest received. Interest received to be as follows: 6 out of 12 times 6% given there times nominal value, which is this one. This is equivalent to 3,000. So how can we record this one? We are going to write here under this column. Here we are saying that bank, we are receiving the interest. So the interest column, it is this one. So we are saying that the interest that we are going to receive is 3,000. Okay, so again, no transaction took place until December 31st December. Again, we are going to receive the interest, and the interest will be the same: 6 out of 12 from June up to December times 6% times nominal value, this one, which will give us the same amount, which is 3,000. Again, we are saying the bank, that is interest that we are going to receive this much on 30th June. But at the end of the day, we need to close our account. So we are saying the balance that will be carried forward next period to be as follows. Here, by looking here, it will be 100,000, and here to be 6,000, because this side is higher, 6,000. So the difference here to be 5,000, and this 5,000 to be transferred to the income statement and the profit on investment. So this will be the profit. Then here will be the same 100,000, which is also the balance will be the same, and here the total is 90,200. So when you go to the next year, that is 2018, the balance will be the same as balance BD, the same 1,000. Here we are saying that 90,200. So by proving that we didn't receive much more than what we are supposed to receive, you can see here from March up to December, it means that is 8 months. So if it is 8 months, automatically, if you are taking 8 out of 12 times 6% given there times nominal value that we purchased, automatically be getting the amount which is equivalent to 5,000, which is a proof of the difference from this one and this. So this will be our income to be transferred to the income statement. Thank you very much. See you next time.